We are live.
Great, thank you. So I want to call the meeting to order. And if you call a roll, please.
Yes, Max Starks.
Present.
Mary Kate Murin.
Present.
And Maurice Lindsay.
Present.
Thank
Excellent.
you.
Thank you. Can someone put up the agenda? The meeting materials? And we can get started. Excellent. Thank you so much. So looks like we're going to start with our fiduciary governance calendar.
Okay, I can share my screen and walk us through that portion of the report as usual. Can everyone see that okay?
Yes.
Okay. So we'll give you an update on the quarter from a market perspective and the portfolio perspective, and then we'll make sure we leave some time for the other topic that John Tudrin has to discuss with the committee. So we'll jump right into it. But as always, if there's any questions, please don't hesitate to just interrupt me and we'll make sure that we address them. From a governance perspective, this quarter, we take a deep dive into the investment side. So we always go over the investments, obviously, but typically here we'll pick out a couple of themes in the portfolio or a particular asset class or trend in the marketplace and really dig into the impacts of that and how it's kind of either positioned for or against that from an allocation perspective. And we thought kind of the hot topic of at least the last quarter and really the last 6 months has been inflation coming out of the pandemic and the recovery. And if you recall, in the long-term portfolio, we do have a dedicated allocation to real assets that was there purposefully to help hedge against an inflationary environment. So we'll dig into that a little bit, but just to set the stage, so as I'm sure everyone's seen in the headlines, right? Inflation has spiked over the last 6 months. Interest rates have moved up alongside of it. And that really is the result of a tremendous amount of monetary and fiscal stimulus, some major dislocation from supply chains and a lot of pent up demand that's all of a sudden kind of being re-released into the marketplace. So all of those things, generally would be, causes for concern from an inflation standpoint. Here, the money supply is one of them. So just how much cash is available. You can see that that's spiked up dramatically. So that's kind of one concern that's out there. To counterbalance that, the velocity of money or how quickly things are being transacted in the marketplace is actually well down. So there's a lot of cash that's being out there, but in terms of actual transaction activity, it has stayed, relatively low, although you can see that it has started to move up a little bit. Unemployment has come down dramatically, although has kind of leveled off around 6%. We won't dig into all the reasons for that, but there's a number of them. And because unemployment's a little bit higher, maybe that's one argument against inflation kind of moving out of control. And then lastly, you'll see that during the pandemic, we saw personal savings rates move up pretty dramatically. We've seen them come back down as the economy started to open, as people are starting to spend some of that cash, but it hasn't been quite as dramatic as the uptick. The biggest headline we're seeing is year-over-year inflationary changes, and they are quite high, as at the levels that we haven't really seen since the last couple financial crises, dating back to the financial crisis or the early 90s. That's driven by a couple things, and most of it is the fact that, yes, there has been some supply-demand imbalance, but we're coming off really low base levels. So if you remember, these are kind of annual year-over-year changes. So when you start with very low numbers, it doesn't take a whole lot to make them jump up like that. The Fed is aware of it. You've probably heard some of the press around the Fed. They kind of acknowledge that inflation pressures have moved up. They're not overly concerned about it, although they have started talking about potential rate increases to get ahead of that sometime in 2023. So certainly starting to keep more apprised of that. And the other thing to look at is that break-even inflation rate. So this is really the market's prediction of what inflation is going to do over a 5 and 10 year basis. And what this is it looks at a nominal treasury bill and looks at a similar duration TIP or treasury inflation protected security. The only difference between those two is what the inflation expectation is. So that's what that break-even is. So essentially what the market is kind of saying is that they expect inflation to kind of hover around 2.4 to 2.6% over the next 5 to 10 years, which is certainly a little higher than the Fed's 2% number, certainly higher than what we've experienced really over the last decade, but certainly not, overly dramatic, at least at this point. So we're still big believers in this kind of short-term view that this is more of a tertiary scenario or short-term scenario while we kind of work our way out of some of the challenges that a forced recession in the pandemic caused. But still paying attention kind of in the background on some of these more traditional kind of economics 101 definitions of inflation. And typically when you see a lot of money supply, low unemployment rates, and then that velocity of money start to pick up, those have tended to be inflationary longer term. So kind of keeping this on the back burner, paying attention to it. But our opinion is that this is more of a short-term trend. I think that's the general market consensus as it sits today. For right or wrong, something to pay attention to. But then lastly, how that plays a role in the portfolio, and I foreshadow this a little bit, is that we look at various asset classes during different types of inflationary environments. And you can see that during falling inflationary or deflationary periods, which is somewhat rare, things like bonds do well, more traditional asset classes do well. In stable environments, all asset classes tend to do fairly well. But in these rising interest rate or rising inflationary environments, traditional bonds struggle, stocks struggle in the short term. And it's really these real assets, things like commodities, precious metals, stocks that are related to natural resources and energy, REITs tend to be the bellwethers in those types of environments. We've had a meaningful allocation, not overly dramatic, but about 5 to 7%, give or take, in that longer term pool as a hedge against inflation, unexpected inflation. And you'll see that those asset classes have performed quite well, kind of in line with what we'd expect to through the first half of this year. And so that's kind of a theme that we've had on in most of our longer term pools of capital for clients, and one that we think is a kind of a strategic allocation and one that's very difficult to time on a tactical basis. So I've been happy to have that, and it's kind of playing its role exactly as you'd expect it to. So I'll pause there and just see if there's any questions from a governance perspective or any questions on inflation or that theme. And if not, we can jump into the capital markets. Here, and you, Mac, I think you said no, but just to be sure. Okay. From a capital markets overview, we touched on the inflation piece, so that's one of the big themes. The other big theme is that we've continued to see, risk asset classes in particular generate very robust returns here in 2021, and the second quarter was a similar story. That's the result of the stimulus efforts I touched on, growth increasing, positive trends, although, starting to question that a little bit. We'll see how that plays out in terms of vaccines and what that means from things getting back to normal. And then certainly kind of GDP expectations coming in kind of at the levels that we had foreshadowed in this time last year. The markets tend to react to GDP expectations rather than the actual prints. So when you start to see those numbers align with one another, that tends to be a nice stable footing. Here's the GDP recovery. So you can see it's essentially V-shaped. So almost as quickly as we put ourselves into that recessionary environment and GDP was down dramatically, it's only taken us about 18 months to get back. That has been much quicker than most other market cycles, and about 3 times as fast as it was coming out of the global financial crisis. As a result of that, as I mentioned, really all risk asset classes have performed quite well. It's been the more economically sensitive sectors that have led the way year to date, things like REITs, commodities, as I mentioned, value stocks, small cap stocks. Some of the areas that struggled more in 2020 have really been the bellwethers so far in 2021, but really the returns have been pretty broad-based. From a fixed income perspective, we saw rates actually move downward, even in inflation, with the inflationary concerns that are out there. So that's somewhat atypical. Typically, you'd expect to see rates move in conjunction with inflation expectations, as we did in the first quarter. But a modest decline in rates meant a positive quarter for fixed income. Continue to be rewarded for owning spread product, although you can see spreads have tightened in very dramatically. So not being compensated nearly to the levels that we were for taking additional risk in fixed income as we were this time last year, which is something to pay close attention to. On the equity side, given the robust returns, valuations continue to look quite stretched Here we look at trailing 15-year PEs. So again, these blue lines are the median. The dark blue rectangles are one standard deviation, where we'd expect to, 2/3 of the representations to fall. You can see how far outside that we are. So close to 2 standard deviations outside. We did see valuations actually come down a bit in the quarter as the earnings part of that, or the denominator, have been quite strong and have helped offset that a little bit, but still, pretty dramatic, particularly here in the US. So I think our general consensus is we think that there's enough support from a monetary and fiscal standpoint to support equities here in the short term. But at some point, these valuations are going to start to matter, and we're starting to pay close attention to that in terms of implications longer term. I won't go through this, but an interesting chart just to look at. It's just kind of a reminder of the case for diversification in terms of asset classes ebbing and flowing and not putting all the eggs in one basket. So you can see things diverge over time. And then we've just included really a broad scope of all the major market indices, just as a point of comparison. I'd just give you the sense that on a 1-year basis, fixed income is essentially flat, down about 30 basis points actually. Global equity markets are up notably. S&P up 41%, EFA up 32%, and emerging markets up 41%. So very robust returns there. And then we've seen real assets recover again in that inflationary environment. So from a kind of an expectation, what we're looking at, certainly equity valuations and kind of how things play out in the short term versus the midterm, keeping an eye on inflation, although again, we expect that to be more short term in nature than long term, but it is something to pay attention to. Certainly keeping an eye on this trend in the Delta variant in terms of what that means from some of the positive momentum we've had from a return to normalcy and in a growth standpoint. And then lastly, managing through a very low interest rate environment, making sure we provide ballast in the portfolio, but also recognizing that we have return expectations to meet, and kind of not just accepting a negative real return from a major part of the portfolio, which we'll touch on some more when we dig into it. So I'll pause there and just see if there's any questions, and if not, we can flip over to the portfolios. Okay. One thing to note is we are making a manager change in the portfolio for the hedge fund mandate. So this is more of a relative value transition than anything. Our team did a deep dive on some of the fund of funds partners we use. And we feel like we have some better options on a go-forward basis. So we put a liquidation notice into Atos in late June, which means we'll get the proceeds in September, end of September, and then we'll get that redeployed to a new manager. It's likely going to be a firm called Ironwood, which runs a very similar strategy, actually has a little bit less market beta in it. It has done a tremendous job in terms of kind of finding alpha sources that are very lowly correlated to traditional equity and fixed income returns. So we're excited about that move, but just to keep you aware that that's happening behind the scenes. From a performance standpoint, looking at the long-term pool first, we ended June about 14.2 million. You can see essentially in line with target allocations, a little bit underweight fixed, a little bit overweight equities, just a result of market movement. We did, as I talked about in our last meeting, we did trim down the Diamond Hill value exposure after a very strong run from value and a manager in particular. So that was really a positive driver of performance and took a little bit of that gain off the table. So you'll see that reflected in some of the cash flows. And then from a return standpoint for the quarter, a little bit behind the benchmark, but still a strong absolute return, up about 5.1% net of all fees versus 5.5. Year to date, strong on an absolute and a relative basis, up 9.1 versus 8. And then fiscal year to date up 29.1 versus 25.2. So very strong again, and from both circumstances there. And it's very similar trends to what we touched on last meeting. Fixed income has been quite positive. So in a year where I mentioned that the bond, core bonds were negative, the portfolio is up about 5%. And that was kind of using the more dynamic approach from BlackRock, having some non-dollar exposure here as well, and then some good active management along the edges. So that was quite positive. Domestic equity strong as well. A little bit of a pause in the quarter as value underperformed growth, but you can see Diamond Hill continues to have a great track record, and they were really the driver of that 1 year performance, up 47 versus 44. We did make that change to Conestoga here. They tend to be a little bit more conservative and on the quality side from a growth standpoint. We did that purposely, given what has led growth markets, particularly in small cap. It's been a lot of the non-profitable, highly leveraged, high beta, more names that are focused on things like biotech that are more sentiment driven than kind of business driven. So we've purposely made that switch into Conestoga as a result of that to take that quality bias on a go-forward basis. Haven't benefited from that yet, but we're pretty comfortable with that posture. And then on the international side, again, returns were pretty strong across the board. Most of it driven by Dodge and Cox on the value side, and then Schroders on the emerging market side, which have both been long-standing mandates and have performed quite well. Lastly, on the alternative side, here's that principal diversified real asset piece, up 28% on a 1 year basis, and then REITs up 38%. So that's that real asset exposure I touched on, which again is about 10% of the portfolio. And then Atos actually has performed quite well. If you think about it, relative to this peer group, it looks behind benchmark. They take quite a bit less risk than the average peer would. So it's not surprising to see those numbers in a very strong market. I think on the positive side, we think of Atos as playing the role of diversifying that equity risk in the portfolio. And if we had kept that in core fixed income, we would have had up 5% or maybe even worse return there. Whereas here they put up 15.8. So we're able to create some absolute return as a result of that while maintaining that volatility profile. So it's nice to see that coming from the hedge fund side, which for a while, right, had been a little bit frustrating to stay the course in a very strong equity market, really not being rewarded for that hedge fund exposure. So I'd say generally, everything with the exception of Atos looks great. We'll make that transition in September, and pretty comfortable again with the postures, and certainly happy with the results both year to date and on a 1 year basis. But again, I'll pause there and just see if there's any questions.
Mike, from Atos to Ironwood, is the liquidity provisions the same, like quarterly liquidity? And what about?
Yep, quarterly liquidity. I think actually Ironwood is only a 45-day notice, which is a little bit less notice period than Atos, but there'll be quarterly liquidity after a 1 year soft lockup for the first year. And just in terms of the liquidity stuff, Tony, just for bigger picture, because it'll come up in John's conversation, the remainder of the portfolio, the other 90% plus or 92% of the portfolio is liquid within a day. So can certainly manage from a liquidity perspective if we had to take a draw, even in that kind of 1 year soft lock period.
Yeah, Mike, I was expecting strong results, so it was good when I flipped through that I actually saw the strong results. So very good, and very good setup.
Yeah, I mean, the implications are, who knows what that will mean longer term, but we'll certainly take it where we can get it.
Exactly right.
On the short term,
I was just going to say, good to see Mike. I feel like we've been talking about Atos for about 5 years. So, I appreciate the strategy, the thinking, and the way you've sort of walked us through this. Thank you.
Yep. And then lastly, on the short-term side, kind of here, everything is status quo is not a great word, but it kind of really is. This is a very conservative pool, about 4.95 million there. Here, we're just trying to generate you a better return than cash or money market, while still providing a lot of downside protection and very little price movement. So a positive quarter, up about 60 basis points on a fiscal year to date number, which isn't overly exciting, but when money market is zero, in most circumstances, at least it's something, and then longer term, it's kind of trended that way as well. Then we'll dig into this pool a little bit more here in a minute in terms of expectations as part of John's broader conversation about some additional capital to put to work potentially.
Okay, good update. I mean, nice and thorough. Yeah, like I said, I mean, when I went through the results, I mean, the returns were what I expected on the long-term side. This short-term is, like I said, very, very different approach here, but we're getting what we would expect in the long term with some conservatism. You know, we certainly don't want to be too aggressive there, but it looks all good to me. Any questions of Mike? Okay. Thank you, Mike. Appreciate that.
Sure.
And next on the agenda, can you put agenda back up, please? Excellent. Thank you. So now it's our potential investment funds. Is John?
Yeah, so I can jump in for a minute here and then do an intro for John. So we wanted the committee to know that our cash position is much stronger than it usually is at this point in the year. And so rather than leaving those funds in our TD Bank account, I asked John to do an analysis to look at an investment strategy, and he also got input from Mike. So I'm going to ask John to present that analysis, discuss our strategy. Mike will add some input as well. And, you know, the strategy is, I believe it does not require a vote from the committee, but we really do welcome your questions and feedback. So we really thought that just given how different the situation is compared to what it usually is at this time of year, we just wanted the board to really understand where we are and what our options are for investing the cash. So with that, I will turn it over to John.
Great, thanks, Andrea. Could I ask to, oh, okay, I'll share my screen here. Okay. Can everybody see the screen okay? Okay.
Yes.
Perfect. Okay, so what this shows is our cash and investments. Starting off, it shows a 3-year trend, starting with FY 18, 19, and 20. And so you can see how the blue shaded area represents what's invested into the long-term portfolio. The orange section is the short-term portfolio, and then the gray section is what we have what we had at TD Bank at June 30th for the respective years. So you can see the consistency over that 3-year period. And then when we hit this past June, you can see how our cash at TD spiked to $15 million. And so, like Andrea mentioned, that we wanted to put those funds to good use for us. So over to the right side of that black bar, you'll see 3 different options or scenarios. The first option would be to transfer fund. Okay, so let me actually back up one step and say that we did a cash flow analysis through the rest of this fiscal year. And going through that process, we felt that we would be in a position where we'd be able to transfer $10 million from the account at TD Bank to investments for Fiduciary to invest for us. And when we do that, we're looking at 3 different scenarios in which 3 different strategies, allocating it in different amounts between the short-term and long-term portfolios. So option 1 is just illustrating us transferring $10 million directly into the short-term account, certainly the most conservative approach. Option 2 would be to transfer a split, $5 million into the short-term portfolio, $5 million into the long-term portfolio. And then option 3 would be transferring $8 million into the long-term portfolio and $2 million into the short-term portfolio. A couple of other interesting notes. For FY20, we did not reallocate as we typically would at the end of the year. Typically when our financial statements are finalized, we take a look at our unrestricted net position and we would reallocate between the short-term and long-term portfolio. If we followed our strategy and our policy, then that would have left us with about $500,000 in the short-term portfolio, which at the time, the college recommended and the committee was comfortable with not reallocating between the portfolios. There was too much uncertainty with COVID, enrollment, and a number of other factors. So I just want to make that note. If we would have, again, transferred, it would be approximately what option 2 is, and that's transferring, $5 million into the long-term portfolio. So I just want to put that perspective in front of you. If we can advance to the next slide. These are the numbers that support that graph, and it's just broken out a little bit differently. On the left side of the black line, you'll see the allocation between the short-term and the long-term portfolios. Generally speaking, you'll see that we're between 25 and 30% allocated to the short-term portfolio, with about 70 to 75% allocated to the long-term portfolio. On the right side of that line, you'll see how we take the cash position at TD Bank into consideration, just to kind of see the funds that are readily available to us should any short-term needs arise. And so this kind of runs us through the different options that I just explained. With that, I reached out to Mike, let him know what our considerations were, what our opportunities were, and he mentioned that he'd be able to put together a range of outcomes for us, as well as putting together some volatility figures. We had a good return this year, as he just presented, for this fiscal year. Obviously, that's not any guarantee of future results. And so what I'd like to do is turn it over to Mike to spend a couple of minutes just running through what those range of outcomes could look like.
Sure. So this chart should look familiar, although somewhat detailed, but essentially what we did here was just give you a sense of kind of what the difference between the return and the risk are from the short-term pool and the long-term pool. And talking with John, I guess the mindset that I would encourage you to have is that, money that would go into the long-term pool, the mindset is it should be staying there for 5+ years. And the reason for that is showed on this slide. If you look in the kind of the gray bars where it says forecasts, you'll see and these are based on our capital market return expectations. We'd expect that long-term pool to generate about 6.5% annualized over a 20-year period, with a volatility of about 12.5%. And from where we sit today, we expect the short-term pool to generate about 1.3%. But you'll see the volatility is only about 2%, as you would expect, right? So there's a notable pickup from a return standpoint from the short term to the long term. The short term, is certainly 1.3% is better than cash right now. So kind of at a minimum, right, you'd expect to try to maximize the return there if you can, even keeping it conservative. But I'd say maybe the better way to read this is like, what does that mean from a worst case scenario, and why would we say 5 years? And if you look at those kind of normal, the 2 flood scenarios over there on the right, this is the non-normal flood is looking at basically a worst case scenario, is looking at the average negative return in the 5% tail of a distribution of a bell curve. So, you'd expect, the portfolio in a terrible scenario to be down about 31%. Generally, when you see pools down that much, it takes somewhere between 3 and 5 years to recover that loss. So that's kind of where that 5-year number comes from, right? We don't want to be forced selling securities and equities at depleted levels if at all avoidable. And then contrast to that, the short-term pool, as you would expect, given that it's very conservative, very low duration, even in a very challenged scenario, you're talking down 3 to 4%. So the recovery there tends to be a lot quicker. So again, really just to set the stage is that yes, there is quite a bit of return give up between the short-term and the long-term pool, but there's also quite a bit more risk that comes with it. So the long-term pool, as we've always intended, has been built in a way, not for cash you're going to potentially need next year for a capital improvement or something you may need to draw on, to backstop operations or whatnot. It's really meant for kind of long-term growth and to kind of facilitate that type of time horizon.
And are you good with these slides?
Yeah, those are just kind of supporting if there's any questions, but we can skip through that.
Great. So a couple of considerations that we were keeping in mind as we were working through this strategy is, there's the potential FY23 budget shortfall. It's an unknown, but there's a potential shortfall that we could potentially turn to cash and investments if needed. There's the potential need for capital investments. Building 20 is one of those potential needs. And then there's the uncertainty with enrollment in COVID-19. So again, with these uncertainties, we still want to have cash available to us should any of those needs arise. So what our strategy is, after looking at the different strategies and options, what we believe would be the best fit would be to transfer the $10 million from TD Bank to Fiduciary under option 2, where we would be investing $5 million to the short-term portfolio and $5 million to the long-term portfolio. Talking this process through with Mike, one of his recommendations was not to transfer the full $5 million into the long-term portfolio all at once. Considering that's a sizable amount to invest, considering the size of our current portfolio, it would make sense to do more of a dollar cost average approach, in which initially we would transfer 10 million to Fiduciary, with 9 million going into the short-term pool and 1 million going into the long-term pool. Approximately every month, we would be able to transfer, or Fiduciary would then reallocate $1 million from the short-term pool to the long-term pool, again, hedging against any swings in the market. By doing this, it would also allow us to reassess in October or November to see, we would have our final financial statements, so we would know exactly what our financial statements look like, and specifically our unrestricted net position. We would have a little bit more clarity on enrollment and potentially, the COVID-19 scenario. And then if needed, we would have about $3 million transferred, $3 to $4 million transferred into the long-term portfolio at that point in time. We could pump the brakes if needed, or if it was determined that we were in a position where we could transfer additional funds, we could continue with that strategy, transferring $1 million from the short-term portfolio to the long-term portfolio until we hit the appropriate goal. So does anybody have any questions or other input that they'd like to share?
So John, in terms of the cash need in the short term, so when Mike talks about, keeping funds in long term for 5 years, how much cash could we potentially need to cover some of these building 20 investments? And I'm just, so if we talk about, moving $1 million over, on a kind of scheduled, that makes sense. But if we need those funds for other purposes, then why move any of that into long term? Why don't we keep that in short term until we resolve these considerations?
Yep. A couple of thoughts are that we do have the opportunity to receive a significant investment. As we saw what the market has done for us and what our portfolio has done over the past year, we do have an opportunity to earn a significant amount of return. We also have, in this scenario, we would have $10 million in the short-term portfolio. So not an insignificant amount of funds available to meet these types of needs. So we feel like this would put us into a comfortable position to be able to react and meet these needs if needed. If additional funds are needed, as Mike mentioned, the funds are daily liquid if necessary.
Can you go back to that slide that shows the actual numbers, yeah, go back up. Yeah, right. Oh, back down. The next slide. Yeah, that one on the bottom of it. There we go. So actually, you're not doing any. You're essentially not doing any of these. I mean, you're talking about $10 million in short term day one, right? Well, 9 million day one, and then what was the intervals of the $1 million transfer from short to long?
Yep, it would be the initial transfer would be 9 million to short term, 1 million to long term, and then it would be 1 million every month thereafter until we hit the $5 million goal. Hit the 5 million.
Okay. Yeah. So your analysis says that we need to keep 5 million of that more liquid. Okay. And will that satisfy that the left side of that prior slide that showed all the considerations, all the potential funds needed for building 20 and the like, or would we still need funds out of long term to satisfy those considerations?
Can't say with 100% certainty because building 20 still remains an unknown, but it does put us in a strong position to be able to meet those needs. You know, with the $10 million, not to mention the cash that we have at TD Bank, it does put us in a great position, in a comfortable position to be able to respond to those needs.
Yeah, my point is that, you know, just ultimately we don't want to, kind of to Mike's point, we don't want to take funds and put them into the long term if there's even a possibility of us kind of needing to dip into those funds. So, I mean, if your analysis says that, you know what, the likelihood is we won't need that $5 million, then I'm certainly all for it. But just want to make sure you thought that through.
Yes.
Zach, the other thing I would add too, so kind of looking at option 2, right, between the TD Bank and the short-term pool, there's going to be $15 million there. There's going to be, call it 20 million in the long-term pool. If for some reason you said we need $20 million of liquidity, we can only get 15 of it from those other 2 pools. In the long-term pool, we're in a choppy market environment. You know, 25% of the allocation is still fixed income. That's quite conservative, which should hold up and maybe potentially even appreciate in a choppy market environment. So even if we were forced to sell something from the long-term pool in a kind of a difficult scenario, we could certainly get creative on where we raise from that, not have to force sell, you know, equities or anything like that at depleted levels, you know, up until about an additional 5 million. So there's kind of about 20 million pretty conservative stuff on a total look-through basis at the end of the day.
Got it. And what again is the rationale for the monthly transfer of the million? I mean, why not just move the entire 5 million day one? That way we're getting that better return, hopefully.
There's just it always makes me a little
Mike,
bit.
I can help.
Essentially, we'd be increasing the value of the long-term pool by about 25% overnight. And just given where we sit with COVID valuations, uncertainty, it would really stink if we put $5 million in there and next week the market decided to get volatile. So, you know, potentially there's a little bit of give up on the upside, but it does allow us to make sure that we don't make a kind of a market timing mistake and kind of time that at the wrong time. So it's more just a little bit more conservative approach to getting that money to work and not making a big bet one way or the other on market appreciation or depreciation as a result of that. And I'd say most committees tend to prefer the side of caution rather than making a big allocation with the risk of, you know, a month later seeing the 5 million be 4 million, you know, before we really even get started.
I can marry that.
Which could happen after the 5 months. And it's the same way. I mean, there's no guarantee,
Yep.
you know.
There's 2 things operationally though that this helps buy us time, this middle way, if we'll I guess offer that sort of outlook. One is we'll know by mid-September where did enrollment land. Right now we're tracking 8% down over last year, but again, it's encouraging. The momentum is perhaps beating our budget projection. So we're going to know a lot more in about 6-8 weeks, and I think that will help us with this plan. For trustees as well, we also anticipate resubmitting a major capital project to DCAM. The date on that is Christmas, and that will actually allow us, with this committee in particular, to look at how have our enrollment conditions married into the economic conditions. And we might be able to then put a number specifically in there that the trustees can commit to. That would be new and different, to say this amount the college via the trustees is willing to contribute to this Building 20 project. We've not done that before in previous submissions.
Okay, any other questions? All right, thanks for the update. You go back to the agenda. Excellent. So there's no old business, any new business? Okay, well, hearing none, our next meeting is Tuesday, November 9th. Thank you all. Mike, thanks for another great update, and we'll adjourn the meeting with a roll call.
Max Starks,
Yes.
Mary Kate Murin,
Yes.
and Maurice Lindsay.
Yes.
Thank you.
Great, thank you. And
Thanks
have a great
again,
night.
Everyone, take
Thank you.
care.
Okay,
Take care.
thanks all.
Yep.
Okay, bye.